Over 200,000 of you watched my Australian dividend series, so in this video we're skipping over to the UK and sharing the top 9 dividend stocks right now on the London Stock Exchange. Today I'll be using a screener from today's video sponsor, Stockopedia. They have a fantastic platform that offers investors several market-leading tools to do in-depth research on over 63,000 stocks from all over the world. There are over 1,200 companies listed on the London Stock Exchange, so having a tool like Stockopedia can help you filter and sort your way through, leaving behind only the best of the best. In this video, we'll find the UK's top 9 dividend options right now, dive into what they do, how they make their money, and of course, their dividend history and their yield. First up, we have to narrow down our 1,200 London-listed stocks to only those paying a dividend yield of at least 4%. This is what I consider to be a fair hurdle rate for a dividend stock, to ensure that we remove companies that pay dividends less than the interest on a term deposit. This eliminates about 80% of the UK's listed stocks, leaving us with 253 to research further. Second, I like to filter out smaller companies. We want strong, blue-chip stocks that have been around for a while and built economies of scale. For good measure, let's go with £250 million, bringing us down to just 160 odd stocks. Dividend yield can be a tricky metric by itself, as it takes the previous year of dividend payments and divides that by today's price. If the price has dropped 50% over the past year, the yield would be artificially inflated, despite investors obviously trying to sell out of the company. As dividend investors, having a reliable payout is critical. Switching to a chart view, several stocks have seen a price reduction over the past year, despite the economic tailwinds, such as pets at home. Removing all the stocks that had a negative gain over the past year, we're left with 66 stocks. I also like to look at the 5-year price trend. Over the long run, as dividend investors, we'd expect our initial invested capital to be preserved. If the 5-year price movements are negative, we may as well put our money in a term deposit where it's potentially safer. Jumping into the charts, we can change our term period to 6 years. And there, we can see there have been some really average players. So if we scrape those out and only keep those with stock price growth of at least 5% per annum, we're left with 28 stocks. As you can see from the charts, all of the remaining stocks have steady long-term capital gains, some with more volatility than others. Next, let's eliminate companies with excessive debt through the net debt-equity ratio. Companies with large debt relative to their equity often face issues when the economy slows down and are more susceptible to interest rate increases. Now, though interest rates have obviously started to fall over the past year, it's still a cost that debt-heavy companies will need to bear. Low debt and high cash flow businesses are generally more reliable as dividend stocks. Filtering out stocks with net debt exceeding 50% of equity, we're left with 17 stocks. Next, I like to remove a few sectors from consideration. These are usually investment funds or REITs that don't often operate like a traditional business. They trade assets, which can have its ups and downs, and overall is not something I look for in dividend stocks. That brings us down to just 13 stocks. And finally, one cool feature you get with Stockopedia is their StockRanks feature. For every stock, they weigh up 3 primary drivers of stock market returns: quality, value, and momentum. Behind every driver, the Stockopedia team scans through the financials and assesses various factors, giving an eventual score. Those 3 factors are then assessed, and then a StockRanks score is given, which over time has shown to be a positive indicator of a stock's strength. By no means is it a perfect science, but it is a positive indicator. Applying a filter to eliminate any stocks with a stock rank of 80 or below, we get our final 9 stocks we'll be looking at in today's video. Kicking off the list, we have MP Evans, ticker MPE. They're a manufacturer of palm oil with over 66,000 hectares of plantations in Indonesia. Palm oil is a highly efficient crop in Southeast Asia, with yields as high as 3.3 tons per hectare in the region. This is roughly 2 to 8 times higher than other similar veggie oils. This efficiency makes it highly affordable, which is important for that region, and obviously it has been very profitable for MP Evans. The company has a market capitalisation of £600 million, and they've had a steadily growing top and bottom line over the past 5 years. This has pushed their stock price higher too on the back of positive results. Their liquidity ratios are sound, they've got more cash than debt on the books, and Stockopedia are highly positive on the stock, giving it an exceptional 99 StockRanks score. The dividend payment has been generally increasing too. In the past 12 months, it has risen to 52.5 pence a share. On its current traded price, this equates to a yield of 4.3%. They also have a dividend cover of 2.5 times, so based on current performance, they can comfortably pay at these levels. With a growing balance sheet, a growing dividend payment, and a trend of reducing debt, MP Evans might be worth taking a look at. Another palm oil stock paying a high dividend in the UK is Anglo-Eastern Plantations, ticker AEP. They also operate palm oil plantations in Southeast Asia, predominantly in Indonesia, but a little in Malaysia too. In total, they operate over 68,000 hectares. The company was founded back in 1985 and initially listed in London to source funds to acquire existing palm assets that were owned by other UK companies. Like we saw with MP Evans, top line grew rapidly in 2021 on the back of surging prices for commodities like palm oil. Since then, the price has receded a little, which is also reflected in their flat revenue over the past couple years, not growing this to quite the same degree as MP Evans. Like MP Evans, dividends have been exceptional over the past couple years, with just a single payment in the past year of 51 pence. This comes to a yield of 5.9%, with a substantial cover of over 3 times. With no long-term debt, £200 million in the bank, and a market cap itself of £330 million, Anglo-Eastern Plantations is another high-paying palm oil stock in the UK. Up third is OSB, ticker OSB. They're a £2 billion mortgage lender with around 2,500 staff and a loan book of £25 billion. The stock has tracked sideways over recent years, with its revenue and profits tracking up through to about 2022 and receding thereafter. This is in line with a stagnant housing market in the UK and rising interest rates over this period. Regardless, OSB continues to pay strong dividends despite the headwinds, with 33.6 pence paid per share over the past year. On the current price, this comes to a yield of 6% with good dividend cover. So if you're wanting exposure to dividend stocks in the financial services sector, OSB might be worth considering. Fourth, we have Hargreaves Services, ticker HSP. They have diversified operations across infrastructure services, land development, and German joint ventures. On the services side, you can see here just a few things that they do. And on the land side, they are actively developing over 9,000 acres of brownfield sites across the UK. So they have their fingers in many pies, and the stock market has rewarded them with positive movement over the past 5 years. With a U-shaped revenue chart, but an inverse U when it comes to profits, it's certainly an interesting trend to see. Stockopedia obviously acknowledges their broad expertise and upwards price momentum, but does raise concerns about whether it provides good value at these prices. Basically, there was a £15 million hole in their profits last year as their German joint venture in the steel recycling space struggled. In their annual report, they see this as a return to normal levels of profit for the entity. And actually, their other divisions had improving performance, which is promising. Looking at their dividends, they've held steady over recent years, paying 36.5 pence over the past 12 months. This gives us a dividend yield of 4.8%. However, with a declining profit base, the dividend cover has retreated to just 1.2, indicating unless things turn around, they might struggle to maintain such a high payout. So if you're looking for a diversified dividend stock, Hargreaves might be something to look at. Fifth is a company we all know, Sainsbury's, ticker SBRY. They are one of the UK's largest supermarket chains with over 1,400 locations and a market cap exceeding £6.5 billion. As a grocery chain, their stock price has held steady over recent years, despite showing positive signs in their revenue, growing 2.5% a year over the past 5. Profitability has been less stable, showing a steady increase in operating profit, but being hampered by close to $200 million a year in one-off restructuring costs in recent years. Investors will be hoping this offers stronger returns in the years to come. Now, over the past year, investors have received dividend payments of 13.6 pence, slightly up on last year, but broadly in line with their payouts over recent decades. On the current traded price, this equates to a dividend yield of 4.9%, albeit with a low dividend cover of just 1.3. So if you want a stable, large-cap dividend stock, Sainsbury's might be worth considering. Up sixth is the largest company on the list by far, HSBC Holdings, ticker HSBA. With a market cap of £160 billion, nothing else comes close. HSBC is a multinational bank with diverse global operations and 210,000 employees. HSBC is perhaps one of the most consistent businesses for a few reasons. Looking at their stock price, over 5 years, it has tracked virtually undisturbed upwards. Revenue has remained at about the same level since 2019, but their net profit has climbed 26% a year in the same period. In the past year, HSBC has paid investors total dividends of 50.1 pence across 4 quarterly payments. At the current price, this offers a yield of 5.5%. So like Sainsbury's, if you want a blue-chip dividend payer, but this time in the banking space, HSBC might be worth taking a look at. 7th, we have Seplat Energy, ticker SEPL. They're a Nigeria-based oil and gas production company with a market capitalization of £1.4 billion. The stock has seen positive momentum in its stock price, having trended upwards over recent years. Top line is consistently increasing year over year, while profits over the past 2 years have been improving as well. Over the past 1 year, Seplat Energy has paid total dividends of 18.1 US cents, equating to about 14.8 pence paid quarterly. This gives the stock a dividend yield of 6.4% with a healthy dividend cover of about 2 times. Seplat's dividend was recently hiked by 28% and features in Stockopedia's top 10 stocks in July 2025 list. This came after its transformational acquisition of Exxon's assets in Nigeria. If you'd like to check out the full report and 9 other companies that feature in this list, you can download it for free via the link in the comments below. 8th, we have TBC Bank, ticker TBCG. As the name suggests, they're a bank in the financial services industry, but instead of operating in the UK, they're based in Georgia with operations there and in Uzbekistan. Like HSBC, there are some great things to point out here. First, the stock price has performed well over the past 5 years on the back of year-over-year increases in revenue and profits. With a market capitalization of £2.7 billion, they're not a small provincial operation and have some decent money behind them. Over the past year, TBC has paid investors a dividend of 221.42 pence, equating to a yield of 4.5%. Now, I know nothing about the Georgia or Uzbekistan economy, but with numbers like these, TBC has managed to tap into a growing market for financial services. So if you're wanting some exposure to emerging market dividend stocks, this or Seplat we saw earlier could be something worth looking into. And finally, our 9th stock is Telecom Plus, ticker TEP. Trading under the brand Utility Warehouse, Telecom Plus is the UK's only multi-service provider, bundling energy, broadband, mobile and insurance services. With over 1 million customers and a market capitalisation of £1.6 billion, they're a fairly stable operator in a sticky market. Their stock price has traded sideways over many years. Revenue has slightly declined over the past 2 years. However, we can see profits increased over the same period. Over the past year, Telecom Plus has paid dividends of 94 pence, sitting at a yield of 4.7%. This payout has increased year over year since the early 2000s, showing there is a culture of returning funds to shareholders. So in the telecom space, it could be one to watch. If you enjoyed the video and want to give Stockopedia a try yourself, make sure to check out my link down below in the video description. Honestly, digging through stock disclosure documents to find the right data can be a nightmare, but Stockopedia does all the heavy lifting for you. It pulls in the financials, charts, ratios, dividends, insider transactions, you name it, and turns them into clear, easy-to-read dashboards. With their screener tool, you can instantly filter thousands of companies on hundreds of attributes. Or you can simply leave it to the Stockopedia experts. Use the preset screens, filter through the StockRanks system, or follow the same processes as well-known investors via the Guru screens. It's like having a team of analysts in your pocket. I use Stockopedia all the time to explore the market, and as I use spreadsheets all day in my job, it's nice to have a tool to use instead of doing the same thing for my investing. They also just released a report on the UK's top stocks in July 2025, featuring some companies with high stock ranks and strong earnings momentum. 8 out of the 10 major economic sectors are covered from this set of companies to offer good diversification principles. It might be useful to compare this against what we shared in this video if you want to look for growth versus dividends. So if you want to give them a go, make sure to use my link down below in the video description, or use the coupon code BC25 at the checkout. Viewers of my channel can get a 14-day trial and a 25% discount on any annual plan. And if you want to watch more dividend investing content, make sure to check these videos out here. Don't forget to subscribe, and I look forward to catching you in the next video. Cheers.